Welcome to Lecture 7 on Risk Management and Insurance. In this lecture, we look at options. An option gives the holder the right to do something. The holder is a buyer of the option. So there's also a second party here in the option market, that's the seller of the option, also called the writer of the option. And the writer of the option gives the option to the holder. So the writer of the option must comply with the wishes of the holder when the option expires. There are two types of options, American ones and European ones. European options can only be exercised at the expiration date. American options can also be exercised earlier. In this course, we deal mostly with European options because it's easier to price them. So let's first look at call options. A call option gives the holder the right to buy an asset at the future date for a predetermined price. This price is called the strike price. It's not called the delivery price as with forward contracts. The asset can be almost anything. Again, it can be a bond, it can be a share, or it could be a commodity like wheat or oil, or it can be a currency like American dollars or yen. So the holder of the option has the right to buy something in the future at a predetermined price and must pay the option price for this right. So option price is also called the premium of the option. And this price is usually paid at the beginning when the option contract is being written. So let's consider a call option on a share with a strike price of 100 and the option price is $5. Now, the following figures show the profits of both holders and writers if the option is held until the expiration date. So if it's actually a European option, which must be the case for European options. So on top here, I have the holder of the options, that's the long position in the option market. So the holder has a right to buy the share at 100. And now if at the expiration date time big T, if it turns out that the share price is 120, so naturally the holder of the option will exercise it. The holder has a right to buy at 100. It turns out in the market it's 120. So it's really easier to get the asset through as a share through the option, and it's cheaper. And so actually the holder of the option makes here a profit of 15. The total payout is 20. But then you have to subtract his initial option price that the holder had to pay when the option contract was written. So again, for every dollar that the set price is here higher at time big T, the holder of the option makes an additional dollar of profit. So we have here again a 45-degree line. Now the market can also turn against the holder of the option. Maybe at time big T it turns out that the share price is 80. So the holder of the option has a right to buy at 100, but in the market can buy the share at 80. So naturally the holder will not exercise the option, but will get the share cheaper in the market by paying 80 for it. So the holder does not exercise the option, just walks away from it, and has this loss of 5. The $5 loss are just the initial option price that the holder paid for the option. So that's the worst thing that can happen, to lose $5. Now, if at time big T the share price is even less, $60, so obviously the holder of the option will not exercise the option and pay 100, but will get it cheaper in the market at 60. So again, just the $5 will be lost, which are the initial price of the option. The holder does not exercise the option. So that's the difference between an option contract and a forward contract. With an option contract, the holder can walk away from it. With a forward contract, you must exercise it. So if you buy something forward, you then really have to pay for it, the agreed price in the future, even if you make a big loss. With the option, the maximum loss is just the initial price that you paid for the option. Now let's look from the point of view of the writer of the option. The writer of the option, we said, has to comply with the wishes of the holder. So if the share price is 120 in the future, and the holder then decides to exercise and just wants to buy the shares through the option contract at 100, the value is 120, so the holder makes a profit of 15. Now the writer of the option must deliver at 100. The writer gave that option to the holder, and so the writer of the option can make a loss of 15. The writer of the option must deliver something at 100, that's the agreed price of 100, even if it's a market now, the price is 120. So the writer makes his loss. So the profit of the holder of the option is equal to the loss of the writer of the option. That's always like that. And if the share price is only 80, and so the holder does not exercise because it's cheaper in the market than getting the share through the option contract, in that case, the writer of the option just keeps the $5, the initial $5, also here. So that's why the writer of the option does this contract. So there's a chance here that the writer of the option can keep this option price. And we will discuss in a later chapter how this option price is calculated. How you do that, what is a fair option price. Okay, that was a call option. So let's get rid of that again. And let's go to the put option. Now the put option gives the holders a right to sell an asset at a future date for a predetermined price. And again, the holder has to pay the option price or premium for it. Here you have again the possible outcomes at the time big T, the possible profits. It depends on what the share price will be in the future. Naturally, we don't know this in advance, so we just show here different possible outcomes. So the holder of the option has a right to sell the share at 100. Now let's assume in the future the share price is only 70. So the holder has a right to sell at 100. In the market, he or she can sell it at 70. So obviously you exercise the option, you sell at 100. And so here there is now a profit of 25. The total payoff is 30, but again, you have to subtract the initial amount that has to be the initial $5 that have been paid for the option. Now, if the market moves against the holder of the option, maybe the share price goes up to 130. So the holder has now the right to sell at 100, but in the market the price is 130. So obviously the holder will not exercise the option and will just sell it into the market. And so the holder just walks away from the option and loses this initial option price, the initial $5. That's now lost. So again, the maximum loss here is the $5. So the maximum loss here is the $5. And then again, the writer of the option, that's just a mirror image. The writer creates the option, gives the option to the holder. So actually, the profit of the writer of the holder will be the loss of the writer and vice versa. So if the share price falls down to 70 and the holder of the put option decides to exercise and to sell it at 100, something that has only a value of 70 and makes his profit, then the writer actually makes that loss. You see, the writer now must take over those shares at 100, but they really have only a value of 70. But the writer has given this option to the holder to sell at 100. So the writer now must really pay 100 for it, even if they have only a value of 70. So the writer loses the 25. The total negative payoff is 30, but the writer got the $5 here in the beginning. So the loss is 25. And if the market moves against the holder, the share price goes up to 130, and the holder has now the right to sell at 100, but the naturally will not exercise and just will sell it more expensively into the market. So here, the holder does not exercise and just loses the initial $5. So the writer just keeps those initial $5. That's the price of the option. Okay, so that's a put option. Maybe one little thing here, we can also look at that. So if we have here, let's go back to the call option. Note that the kink is here actually below the strike price. So if, for example, the price in the future at time big T of the share is 102, then it's worthwhile to exercise the option because this reduces the loss. So loss is now no longer 5, but the loss will be only 3 here if one exercises this call option. So the kink is here. One starts to exercise here at the strike price. And then if really the share price goes up above 105, then the holder here of a call option makes a positive profit. So here first, just a loss starts to fall. Okay. And the same thing is true here with a put option. Here's a kink is below the strike price. Now the next figure summarizes the 4 possible situations in the option markets at the expiration date. Now X indicates the strike price. And on the upper axis, actually, we'll have the payoff of the option and not the profit. So here we have this summary. So I'm neglecting now the initial payment of the option price. You see here, we had also those initial $5 also here. We neglect that now, and then often the figures are just drawn like this, and we speak about the so-called payoff at the expiration day and not of the profit. So with a call option, you have a positive payoff at the expiration date if the price in the market at time big T is bigger than the strike price X. So as an example, if the share was 100, if the strike price is 100 and in the market then the share is 120 at time big T, then you have a total payoff of 20. And from this, you subtract the initial $5 option premium, and then you have the profit of 15. Now, if at time big T the share price is less than the strike price, maybe only 80, then you don't exercise a call option. You see, you can buy it in the market cheaper than through the option. The strike price here is 100, and so the option is not exercised, and so the payoff then is actually 0. You just simply walk away from the option. And the loss will be -5 if the option price was -5. And then we have again here, this was a long call. Here we have the short call. That's the situation of the writer. So if the buyer of the option, as a holder of the option, has a positive payoff of 20, then the writer of the option has a negative payoff of 20. And if the holder of the option decides not to exercise it, so there's no payoff, then there's also no payoff here. The payoff is 0. But truly, then the writer of the option keeps the initial $5 and has a positive profit. So that's the holder of the call option, and that's the writer of a call option. And here's the same figures for the holder of the put option. So that's the holder of the put option, and that's the writer of the put option. The long put and the short put. So just to repeat, maybe you hold an option giving you the right to sell a share at 100. Now, if in the market at time big T, the share price is only 80, then actually that's good for you. You still have the right to sell it at 100, so you have here a positive payoff of 20. And from this you subtract then the initial option price, so your profit is 15. If the market moves against you, 120, you have the right to sell at 100, but in the market you can sell it at 120 in the future. Again, naturally, you don't know this beforehand, but that's just how it turns out, let's say. then here you will not exercise the option. You will not sell at 100 through the option contract if you can sell it in the market at 120. You just walk away and the payoff is 0. And the profit is actually negative. You lose the initial option price of the 5. And here again, then for the writer of the option, it's just the opposite. Okay, here we have a payoff of -20. And okay, here again, there is no payoff. So that's it. 4 possible situations in the option market. Now, when you go and deal in the option market, be careful what you're doing. Particularly pay attention on which side of the market you are. You see, the holder of the option here, long call, or the holder of the put option, the worst things that can happen is a 0 payoff. Now, if you're the writer of the option, then actually your payoff can be possibly, the payoff goes to -infinity. You can have an infinite loss. So writing options is quite risky. Also here, the payoff can be strongly negative. Here you will hit the axis. Here you will hit the axis, so that's a maximum loss that you have. But as a writer of a put option, but here actually with a call option, the loss actually, the negative payoff can be -infinity if the share price is very, very, very high when the option contract expires. So typically, options are bought. Holders of options may be some investors and private investors, but the writers of the option, those are either very rich people or maybe financial institutions like banks and insurance companies. They are writing options, or other financial institutions. As a private person, with modest wealth, you will never write an option. It's much too risky. Or you should not write an option. So be careful here. Options are very safe if you are the holder of the option. The maximum amount you can lose is just the initial price of the option, the $5. If you are the holder of the option, but if you create the option, if you are the writer, then the losses can be actually huge. Now in future lectures, we will actually then use this notation for the option. So a long call, the outcome at time big T is the maximum of those two numbers here. So either you have a positive payoff or you have 0. It's a maximum of the two. You see, it's a maximum of the two. Either it's this positive payoff or it's a 0. If ST is bigger than X, then you have the positive payoff. If ST is bigger than X, if the share price is bigger than the strike price at time big T, then you will have this positive payoff. You move along the 45-degree line. So if your ST is bigger than X, then you have the positive payoff. That's a maximum, so the maximum applies. If ST is smaller than X, then you would have a negative figure here, but then actually the 0 applies, okay, because 0 is bigger than negative. So to understand this maximum notation here, you see here, if ST is lower than X, when the option expires, you will get a negative figure, ST minus X. Now a negative figure, okay, 0 is bigger than the negative figure, so the 0 will apply. So if this gives you a negative figure here, then the zero, you go for the zero. Now with a short call, so right here it's a minimum. You either have x minus st, you have a negative figure here, or you have the zero. It's a minimum of the two. If at time big T, the share price is higher than x, then the holder will exercise, and x minus s gives you a negative figure here. You have this loss here. X minus f is negative. You see x minus s is negative. We go for the minimum. So the minimum applies. If at time big T, we are here and the share price is low, and so the holder here decides not to exercise, then x minus s gives you a positive number. So x minus s would give you a positive number. So x minus s will give you a positive number, but you go for the minimum, so the zero applies. That's a positive, and that's smaller, so actually the zero will be used here. And the same notation we can use for the long put, this maximum notation. In the long put, again, it's if at time big T, we are down here, then the holder of the put option exercises. The share price is lower than the strike price, and the holder has the right to sell at the strike price. So the share price will be less. The holder will exercise and sell through the option contract at a higher price, and the holder makes this profit here. So we have x minus s is positive. So x minus s is positive, we go for the maximum, so this positive profit here applies. And if the share price turns out to be high at time big T, then the holder does not exercise, x minus s gives us now a negative figure. You see x is lower, so x minus s gives us a negative figure. So x minus s now gives us a negative figure, but we go for the maximum here, so zero is bigger than negative, so the zero applies. And similarly, for the short put, you can actually think this through yourself. So that's a very neat notation for the call and put options for those four situations in the option market. And we will again then refer to them later in a later lecture, in a later chapter. Now let's make two examples. Let's assume we have a wheat mill, and the wheat, say, need wheat in, say, produce flour, and they require wheat in 6 months' time. Again, we have here a price risk, and what the mill can do, it can buy an option on the wheat. It can lock in the price by buying a call option, and it will exercise the option if the wheat price rises above the strike price of the option. Then the mill still can get the wheat cheaper. That's safer to do than actually to go to the forward market. Naturally, the wheat mill also could buy the wheat in the forward market. But remember, in the forward market, you cannot walk away. Okay, so you really actually must take over the wheat, even maybe in 6 months' time, the wheat is very cheap in the market. In a forward market, a forward contract, you cannot actually walk away from it. With an option, you can decide not to exercise. So if it's not worthwhile to exercise this call option, then just don't exercise it. If the wheat price turns out to be cheaper in 6 months' time, then just don't exercise the option. If the wheat price is expensive in 6 months' time, yes, then naturally you will exercise it. Now here I have something from CommBank. That's actually, I think that's Commonwealth Bank in Australia. They offered those options to investors, or actually also maybe to a windmill. So that's done by banks in Australia. Unfortunately, those options are actually quite expensive, I must say. So then you really have to think about, is it better to carry this price risk, to live with that price risk, or to buy an option? So option probably will be up to 10% of the wheat price. So it's not cheap, those options. Now you can also use the options for portfolio management. Okay, let's consider a situation where you think that the share market will fall. You think the share market is overvalued and it will fall. What you can do, naturally, you can just sell your shares and hold cash. But that's quite expensive. You have a lot of fees involved by selling shares. And so maybe you don't want to do this. Maybe you also have a controlling interest in a company, and then you don't naturally want to sell those shares. What you can do, you can go to the option market and you can buy a put option on the share. The put option gives you the right to sell the share at a predetermined price. So that gives you a hedge. If the shares fall below that predetermined price in the option contract, then you just exercise the contract and you still can sell the shares at a high price. And so this gives you like insurance. That's portfolio insurance. So that's quite often done. Again, maybe it's not cheap, but that's probably what people should have done before the Corona crisis. The coronavirus crisis, then share prices fell very much. Okay, some people really actually sold their shares before the crisis because they had the information. Okay, that at the beginning, okay, in the early days, in January 2020, some people started to sell shares, but others bought put options, and they bought the right to sell the shares at a predetermined price in the future. And then when the shares really fell, they could exercise those put options and make a profit on those put options, and that offset their losses on the shares. So you can sell the losses on your shares. So that's done, okay, if you think a share price will fall in the future. You can also do it for a single share. If you think, again, a company has bad management, or maybe just somehow shares of a company will fall in the future, then just buy a put option on that single share. Now, a warrant. Now, there are all types of warrants. Warrants is also a legal term. But here actually in finance, the warrant is very similar. The difference between a warrant and an option is very similar to the difference between a forward contract and a futures contract. A warrant is again standardized. They are traded, they are issued by financial institutions. So they are traded at exchanges in so-called secondary markets. So the primary market is where the warrant is issued, but then actually it's traded at exchanges. That's sometimes also called the secondary market. So the warrants also include some safeguards. Options are traded over the counter, and warrants then are traded at exchanges. Typically, warrants are issued by financial institutions. So a warrant, so you have call warrants and you have put warrants. Now swaps. The swaps market is actually huge. It's trillions of dollars. It's an agreement between two parties to exchange cash flows into futures. And usually we have several cash flows than into futures. So most common swaps are interest rate swaps and currency swaps. I do not have the time to discuss the swaps in this class. Really, we could do a lecture on a few lectures on the swaps itself, because they are really actually very important. And the pricing of the swaps, you can actually do through bond pricing, but you can also do it with so-called forward interest rate agreements, where you determine the interest rate in advance for a time period. Maybe you determine the interest rate that you will pay in 2 years' time, from year 2 to year 3 in 2 years' time. So you can also do, so there are two ways of pricing warrants. It's explained, the warrant is explained in the HAL book. So if you go and work in the financial markets, you really have actually to understand what is a swap, not a warrant. What is a swap? The swap market is very important. But I have to refer you here to the literature, because in this class we really want then also to do insurance. So it's not a finance class what we do here. Okay, that was the topic of today. So thank you.